Thanks, Lee, and good afternoon. A big thank you to ABARES, in particular Philip and Paul, for the opportunity to speak here this afternoon. NAB Agribusiness, we're a division dedicated to finance and financial services to Australian agribusiness. It's in our DNA, it's part of our heritage. We're doing it for 154 years. We're market leaders in terms of lending to agriculture, so hopefully today I'll be giving insights into that. I'll be talking about industry data with a few references to our own where we don't have industry data. Today we'll be talking about three topics. Effectively, what does the lender look for? There's a lot of urban myths around this. Secondly, lending to agriculture. What does the book look like? The growth, it's been referred to this morning, but also the composition and, more importantly, the tenor as we go through the crisis. And thirdly, agribusiness deposits. We don't hear about it enough, but farmers are making money. Our deposit books are growing. And the best data we can use today will be the farm management deposit data. They are indeed making money. So the first slide. Financing the farm, what does a banker look for? It's a bit like going to the dentist sometimes, isn't it? But I think there's a lot of urban myths. It's quite straightforward. I call it the 5 C's. Character, capital, cash flow, capability and collateral. Indeed, in the first slide here, I put character first and collateral last, security. It's often asked a question, but it's about the integrity of the individual, and of course security and collateral comes last. I'll just quickly run through some notes on the 5 C's. The first C, character. It's the integrity of the individual. It's not inclusive, or it's not limited to, but it's extension of that gut feel around honesty, openness, transparency. It's the people factor, the human capital. We haven't heard much of it today, but it's around that management. And of course, there's many factors relate and feed into character: motivation, passion, drive of the business owners, management, to see the business succeed, and of course, retiring and paying debt. The second C, capital. This is the amount of capital invested, both in terms of absolute dollars, but also the proportion of overall asset base. The mix between debt and equity, thus the related interest costs, is fundamental to any lending proposal. There's no silver bullet. It's been referred to about the leverage and the equity ratios. Look, 70%, 75%, even 80% has been thrown around for many years. They're great traditional numbers. But 70%, 75% may be over-leveraged for some producers and indeed under-leveraged for others. This varies between entities, of course, due to different production systems, different mix, management and capability. The third C, cash flow. Cash is king. Surplus cash after operating expenditure, after capital expenditure, after tax, after drawings is what repays debt. Revaluations, updated valuations of the country, water, etc. The top price pen of steers, crop competitions, etc., etc., etc. They're all great, don't get me wrong. But it's actually surplus cash after operations, after tax, after drawings, which is what retires and repays debt. Lenders look for updated cash flows, forecast cash flow budgets, what's the peak debt, when and how will it be funded, what's the optimal time to align principal interest repayments, how much interest only is needed after expansion, what term is required for the core asset. We are funding long-term assets, require long-term liabilities. Lenders do look for business plans. They work through options with the owners around the enterprise mix, the type, and finally the revenue maximising, cost minimising strategies that drive the strongest and largest bottom line, but of course in a sustainable manner. The fourth C, capability. The world is not equal. Lenders look at the physical capability, the capability of the business model, the farming capital we call this. It's the quality of land, stock, water, access rights, genetics, etc., etc., etc. But it's a combination of these efficiencies of those assets which can be achieved plans in a given set of conditions. It's imperative that a banker understands the industry, understands the business, and naturally understands the people. But also, what is the core business? He or she must ask the questions of the core business. Is it robust at the current debt levels? Is it robust at the proposed or forecast debt levels? The final C, the fifth, collateral, security. This is the security lenders look for. In Australia, we have full recourse agricultural lending. There'll be many textbooks written about what's happening in the US. This is a key fundamental aspect underlying the banking system in Australia. Essentially, collateral security is what can be called upon to support the exit of debt, such as livestock mortgages, crop liens, of course, first registered mortgages over land, access water rights, when primary exits may falter or fail. In addition to these 5 Cs, there are many associated risks that the lender will identify. For every risk identified by lenders, we look to what can be mitigated, methods to minimise or raise a particular risk. For example, interest rates, commodity price, foreign exchange, climatic, and of course changes to government policy. The second topic today, lending to agriculture. Again, those urban myths. Credit is flowing to agriculture. We are open for business. This graph says it all. It says 1,000 words. Just focus on the green line. This is total lending to agriculture. This is industry, not NAB data. Lending to agriculture in 1994 was 12.5 billion. This has grown by 48 billion to 60.5 in 2011, an increase of 320%. During this period, as we've called out with the red line, there's 3 distinct phases or stages of growth. First stage, steady growth from 94 to 02, annual growth rates around that 9%, 8.8. Then a rapid rise 02 to 08, a double-digit growth, circa 12.4. And then finally, the last three years. Still growing, there is access flowing, but at a slower rate, 3.7. The key point that despite the GFC, the European debt crisis, cash is flowing to Australian agriculture. We predict over the next, I'm calling next 6 months, 12 months, 18 months, we'll see a rise of confidence, acknowledge the challenging prices, the dollar, but off the back of improved seasonal conditions, water allocations, plus the last 2 years of seasonal growth in deposits, we see that confidence growing. This graph also highlights the changing composition of debt. So in the 90s, it was the smaller lending parcels per customer, that is under 500,000, that Mick referred to, that dominated the composition of the market. However, in the 2000s, this has moved towards the larger parcels, that is over 500,000, making it the larger proportion of overall lending. This next slide highlights this change in composition. To really call it out, the smaller parcels in the 90 accounted for 64%. That is the grey area at 40% and the black area at 24%. And then look at 2011. The aqua in the blue out to 75%, 76%, and the smaller end down to 24%, a market trend. We ask why. I think we could spend the next 2 days of the conference discussing. It's just a simple fact. I'm proposing a number of, I'm calling out a number of factors. The aggregation of smaller properties as farmers exit, the growth of larger farmers, corporates, introduction of non-traditional off-farm investment, ongoing drought conditions, sort of in Bruce's slide, thus the requirement for carry-on and working capital, subsector trends. So we can all talk about Australian agriculture, but of course it's made up of many different subsectors in many different production and microclimatic variances. Subsector trends, for example, the broiler industry. We saw the transition from conventional to tunnel ventilator sheds. We saw different changes. I think Mick probably nailed it. For example, in the West, the shift between focus on livestock and cropping to a focus on cropping. Foreign investment, knowing that not all foreign investment is debt funded. There is a lot of 100% equity funds. And of course, at the smallest end of town, it's people opting out of farming, the ageing farming population, thus downsizing, increased reliance of off-farm income, introducing and entering capital. The list goes on, and evidently this varies between industry, entity-types and family structures. I'll briefly talk through term and tenure. I've had to use NAB data here. So what does the lending book like? And this changes right throughout the cycle, evidently closely related to the GDP, weather, etc. But term debt is approximately 80%. Overdrafts fluctuating through the year, 5 to 10%. Asset finance, leasing, equipment finance, etc. Again, 5 to 10%. As shown here, 60% of the book is hedged. Hedging using interest rate risk management tools effectively mitigate against interest rate rises. As you can see here, 1 to 5-year money is 45% of the book. 1 to 3-year money at 22%. More importantly, over 5 years at 15%. A lot of sectors cannot attract tenor like that. Our agribusiness managers work with wholesale markets, specialists that ensure customers are aware of opportunities, key economic data, GDP, unemployment, everything that we heard this morning. Also worth noting here is the 41% of the customers ride the yield curve. They're comfortable to take the 30, 90-day roll option, effectively still a hedge, but a floating or variable hedge.